Hello and welcome to McQuilling TV. I'm Allison O'Melio, Marine Transport Specialist at McQuilling Services. In this episode, we will be discussing some key findings from the recently published Mid-Year Tanker Market Outlook Update. Global oil demand is expected to rise by about 1.4 million barrels per day in 2015 from 2014 levels, reaching 94 million barrels per day. Non-OPEC supply growth from North America will continue, although at a more gradual pace, reaching 20 million barrels per day by 2016. OPEC will continue to produce above its production quota of 30 million barrels per day. Tanker demand for crude and residual fuel products is expected to increase by 2.5% in 2015 from year-ago levels, as a reduction in oil prices and improving refining economics have stimulated demand. Clean tanker ton miles are forecast to rise by 6.6% as lower gasoline prices have stimulated consumption among drivers, while global arbitrage plays created a dynamic trading environment for products. Our analysis of fundamentals resulted in a mostly upward adjustment to our freight rate forecasts. A slight expansion of 0.8% in VLCC demand is anticipated for 2015 as the benchmark Middle East to Far East trade expands by 6.6%, offsetting a decline of 25% in Middle East tanker flows to North America. Suezmax demand is projected to rise by about 10% as West African exports to both Southern and Northern European refiners accelerates, and a long-haul fuel oil trade from Rotterdam to Singapore emerges. Demand for Aframaxes is expected to decline by about 1.5% this year, as growing trade within the North American region is not enough to offset declines in the staple Northern European market. The largest of the clean tankers, the LR2, will see demand increase by 3.5% in 2015 from year-ago levels, as refinery closures in Northern Europe have increased clean product flows from the Middle East and the Indian subcontinent to this region. With a market share of 20%, LR1 tanker demand will rise by 6.2% as expanding refining capacity in the Middle East and other emerging markets satisfies demand to Northern Europe and the Far East. MR2 ton-mile demand is expected to rise by 8.3% despite lower voyage lengths amid increased gasoline consumption from the U.S. and other Atlantic basin consumers. Global dirty fixture demand reached about 5,090 fixtures through July, a decline of roughly 7% year-on-year. The VLCC segment posted a 1% increase, while the Suezmaxes saw more or less the same amount of volume year-on-year. TCEs have been supported by lower bunker prices, and the VLCC benchmark route, AG Japan, has averaged roughly $63,000 per day through July. The West Africa UKC Suezmax trade has averaged about $40,700 per day. The decline in fixing levels stemmed from the Aframax and Panamax classes, which fell by 16% and 7.5% respectively. Clean tanker spot activity has risen almost 30% year-on-year, as the increase in refining capacity in the Middle East is supporting the smaller clean tankers. Robust naphtha demand in the Far East, particularly Japan, has been the driving force behind the LR2 and LR1 vessels. The LR2 segment posted a 19% increase in spot fixture volume year-on-year, while LR1s climbed 9%. Earnings on the AG Japan route for these two classes have averaged $29,500 per day and $24,800 per day, respectively. MR2 spot activity rose 32% year-on-year, while MR1s climbed 52%. New building values were relatively unchanged in the first half of the year amid a strengthening U.S. dollar. Modern second-hand crude tankers were up between 10 to 13%, while the 10-year-old crude tankers were led by Aframaxes, which were up 25%. We expect the older tankers to rise through the end of the year amid an improving earnings environment. Second-hand clean tanker values were mixed, with 10-year-old LR1s down 11%, but LR2s were up 9%. And that wraps up this episode of McQuilling TV. I'm Allison O'Melio. Thanks for watching.